I'm getting paid $21,000 to buy 1,500 shares of NVIDIA a year and a half from right now when the company is going to be bigger and more profitable, most likely for $100 a share, and I keep the $21,000 in premium. So I spent years studying the stock market and trying to figure out the best options trading strategy where you could win consistently year over year over year, whether we're in a bull market or a bear market, and I found the system that worked for me. I scaled from nothing roughly 5 to 6 years ago to now I have over $2 million of net worth. This is just one of my accounts right here. I scaled it from nothing to over $952,000 in just a few years, and you can see my 2-year return right here, 165%. So I'm going to walk you through in this video my option trading strategy, just one of my favorite ones that I do, of how I scaled so fast, how I scale consistently, and how you can put this in your portfolio right now. So here we go. So there's so many crazy option trading strategies out there that you could look at, and honestly, most people think the options are about doing options. Options has nothing to do with options. Let me say that again. If you're doing stock options, don't ask what is the best strategy to do. Options is all about what do I think the underlying stock or ETF is going to do, and then I go do options to capitalize on that move. So the strategy that I'm going to break down right now, it's a bullish strategy that will work in most market conditions. So selling put options is by far one of my favorite ways that I trade stock options. The reason why is because there's so much flexibility, the time decay helps you, and it's just a way higher likelihood that you're going to win on these trades every single time you do it. I win on roughly 95% of the option trades that I do when I sell put options, and I'm going to break down why I use put options so much, and you could probably guess because I win so much on them, but I'm going to break down why I win so much on them and how you could do this in your portfolio right now. So there's basically 2 option strategies that I talk about. There's one where you swing for home runs, and there's one where you swing for base hits. When I'm selling put options, I'm usually trying to swing for base hits. I am not really going to catch any home runs on it. I'm not going to 10x my money. I'm not going to double my money overnight, but I will consistently scale, get that monthly cash flow in my portfolio. Right now I generate roughly $30,000 per month on average, but I take that money and then I go add it to the base of my portfolio. I buy more shares, I use it for more option plays, whatever you want to do with that money, but I'm consistently getting this monthly cash flow instead of swinging for home runs right before earnings happens, and you know how that goes. It's like a coin toss if you're going to make money on that or not. I don't usually play those games. I like to do the consistent wins that are going to scale my portfolio from $2 million right now to $20 million, then to $200 million down the road. That is what I built right now, so let's go into a little bit more. So for every stock market transaction, whether you're doing options or just buying shares straight up, there is a buyer and a seller. So let's pull up Triple Q right here. This is the NASDAQ. I have a lot of money in Triple Q, and I'm going to give an example. So let's say that you're bearish. Let's say you're scared. Maybe Trump's tariffs are going to crash the market, whatever you think is going to happen. Let's say you think that Triple Q is going to go down in price. So right now it's $529. So what you could do is you could go buy a put option. So when you buy a put option, that's giving you the right to sell your shares at a certain price in a certain time frame. So when you're buying a put option, you're essentially buying insurance. And the reason why that's super important is because when you're buying that option, somebody is selling that option to you. So if you're bearish on Triple Q, maybe you want to lock in a $500 per share sell price that you want to do on your shares. So you could then go buy a $500 strike price put, and you want to do it for maybe a 1-year expiration date. So anytime between now and 1 year from right now, you could sell your shares of Triple Q for $500 per share no matter what happens. Now, if Triple Q goes up, you're not going to want to use that option contract, because if it stays at $529 per share, why are you going to want to sell your shares for $500, which is what the option contract you bought is for? Or you could just sell it for $529 in the open market. You're always going to want to sell it for the higher price, so the option contract will be worthless. So the way that I look at it is I am the insurance company. I'm insuring your portfolio for downside protection, and you're paying me this premium every time that you buy that protection from me. So here's a really important part about selling options versus buying options, especially when you sell put options. You're playing with the emotions of people in the stock market. Everyone in the stock market, for the most part, is very emotional because most people in the stock market honestly don't know what they're doing. Emotions are a very underrated aspect of investing. So think about this with me. The strength of the feeling of losing money is stronger than the strength of making money. So if you walk into a casino and you win $500, you're happy. Of course you're going to be happy. But if you lose $500, you're going to be pretty upset. So I'm going to bring this all back and explain to you why this matters and why selling put options is one of the most profitable, consistent strategies that you can do. But before you close the video right now and just say, I'm going to go sell put options and get monthly cash flow, you have to stay till the end of this video, because if you don't understand everything that I'm about to explain to you, you will not make money selling put options. You have to understand everything that I'm going to explain to you in this video right here, and then I'm going to show you the examples at the end. Don't forget about that. It's really going to help you guys out a lot. I just want to break this down in a no BS way for you guys, how I legitimately make $30K a month on average, and how I scale to millions of dollars. So as we already talked about, the strength of the emotion of losing money is stronger than the strength of the emotion of winning money. And guess what? We're going to use this to our advantage when we sell put options to somebody. Somebody's scared their stock is going to go down. Somebody is scared that Triple Q is going to crash. So I'm going to sell them that insurance. So if it does go down, I have to buy their shares from them at, say, $500 per share, which is what we talked about for the strike price in the example earlier. But I'm going to break down why we don't care about buying the shares for $500 per share. So going back to that emotional aspect, I love to sell put options on days where the market is red and there's a bunch of fear in the market. Because just think about it. If you're scared, if the market's going down, if tariffs are coming, if the stock market's overvalued, whatever's going on, you are more willing to want to go buy downside protection in your portfolio. And when there's more demand to go buy something, the price of that insurance is going to go way up. So when the market's going red and the stock market keeps going down, 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 you are now willing to pay a higher price for that put option. And remember, you're paying a higher price, but you're paying that money to somebody. You're paying that money to me. That is why I love to sell put options when there's fear in the market on high quality companies, high quality ETFs that are just beat up in price and they're on sale. I love to buy things when they're on sale. I'm going to go more into that in just a second, exact reasons why. So I need to give you this example right here just to make sure it really clicks for you and understand how the emotional aspect of this works, because this is super, super important to leverage this to your advantage. So let's pretend that you live in a hurricane area and you're going to go buy flood insurance. If you call up your insurance company and it's a sunny day and you want to buy flood insurance, maybe it's going to cost $1,000 annually. Maybe there's no hurricane on the horizon. Maybe the weather looks good. Maybe it's supposed to be a low hurricane year. So it's only $1,000 per year to insure your home for flood insurance. You're not willing to pay as much because there's no storms on the horizon. So you're not that motivated to buy the policy. So that right there is essentially buying a put option when the market is going up and it's going green. When the market's going up, most people view that as the stock market is healthy. It's not going to crash. Things look good. So the market's trending higher. People aren't willing to go buy put options, but that's actually the complete opposite of what you want to do. As things go up quite a bit, most people want to FOMO into the market and buy when it's higher, but in all reality, that's when you want to go sell into strength. So this is why most people end up buying high and they sell low, because they FOMO into the top and they panic sell the bottoms. But when the market's going down in price, that's when I then like to go sell put options, because now there's more fear in the market and people are willing to pay more for that insurance policy. So let's talk about it right here. Let's say you call the insurance company, but there's a hurricane 3 days out. You are way more motivated to buy that flood insurance, to buy that policy, just like you're buying that put option. You're just buying insurance. But now, instead of paying $1,000 when it was all looking good, now the policy might be $2,000 because there's more fear in the market. There's more fear in the whole world that the hurricane's going to wipe out your house. So you're willing to pay $2,000. Guess what? You're going to pay this $2,000 to me. And I'm only going to sell you this policy if I feel like the hurricane's going to miss your house. You're going to pay me this extra premium and nothing's really going to happen. I'm not going to have to pay out on that policy. So if somebody sees that their portfolio went red multiple days in a row, they start to get nervous as if a storm is coming and the market's going to continue to crash or even go down even more. So this is why the typical emotional investor will want to buy put options to protect their downside when things are going red. This will then push up the put option premiums, and the person selling them the insurance, selling the put, I am the one selling the put, we get to collect that larger premium. So here's the most important part, and then we're going to dive into this account. I'm going to show you an exact trade that I recently did by selling a put option that's looking good so far and making pretty good money on it. You only want to sell puts on companies that are trading below intrinsic value, companies that you're okay to hold for the long run, and companies that you feel like have a durable competitive advantage going forward. If you don't know those three things, you should not just go sell put options on whatever company. I don't care if you're buying calls, buying puts, selling puts, doing iron condors, doing diagonal spreads. It doesn't matter. You have to understand, what do you think the stock is going to do in the long run, and then do options to capitalize on that. So now let's dive into my portfolio. I'm going to show you an exact trade I just did on NVIDIA and how it all breaks down. All right, so let's look at this play right here on NVIDIA. So basically what happened is I collected $21,589 to sell the put contract right here on NVIDIA. I sold 15 contracts. That's why it's minus 15 right here. And I sold them at a $100 strike price. The P is for the put right here. Anytime between now and 6/18 of 2026. So what this means is if NVIDIA goes up, stays flat, or goes down to $100 per share, this contract is going to expire worthless. I'm just going to collect the $21,000 in premium, and nothing else happens from right there. And keep in mind, this $21,000 that I got in premium, I collect this immediately, and then I could go add it to whatever part of my portfolio I want. I could pull it out and go spend it. You could do whatever you want with that, and that's the beauty of selling puts. You just get that premium immediately. Now, in order for me to support that trade, my margin requirement over here is $32,000. So essentially what that means is I need to maintain $32,000 of equity in my account to support this trade because I sold these puts as uncovered. Now, here's the thing about doing it as uncovered, and you're probably wondering, like, well, how are you doing that uncovered if you don't have the cash in your account to take assignment of the shares? Because what happens is if NVIDIA falls below $100 per share, I'm forced to buy 100 shares times 15 because every option contract is 100 shares. So 100 times 15 is 1,500 shares times $100 per share. So I'm going to be on the hook to buy $150,000 worth of NVIDIA shares if this contract goes in the money. Now, keep in mind, I'm going to collect this premium right here no matter what, so it's $21,000. So really, it's going to be $21,000 less than $150,000. So like $130,000 would be my cost basis on NVIDIA. But the reason why you don't have to keep all the $150,000 in cash in your account is because I have a marginable account in Charles Schwab. This is the key. A lot of brokers, including Robinhood, don't allow you to do this. And this should only be done for people that really understand how stock options work, how to value the stock market, how to value a stock, and how to manage risk. So instead of me having $150,000 of cash in my account just sitting there to support this trade, Charles Schwab will allow me to support this trade with $32,000 of equity. Equity meaning I have shares in the base of my portfolio, a lot in a bunch of ETFs, where as long as the value of the shares in those ETFs is above $32,000, I am fine. But another thing you have to understand is this margin requirement right here is going to fluctuate in real time every single day. So if NVIDIA starts to fall quite a bit, this margin requirement is going to go up to the amount of assignment. But there's so much time left in this contract, this isn't really going to move too much on a daily basis. But just think about the margin requirement as a function of how likely the contract is to go in the money. If NVIDIA shares go up, this margin requirement is going to go down because it's less likely to go into the money. And if NVIDIA shares fall, the margin requirement is going to go up. Now, the reason why I tell you guys to only sell puts on companies you're okay to hold for the long run and when you feel like they're trading below intrinsic value is because if I'm forced to buy NVIDIA for $100 per share a year and a half out from right now, who on earth wouldn't want to do that? So you got to ask yourself this. It's like if it's trading at $135 per share right now, why would I not want to buy it a year and a half from now for $100 per share and get paid $21,000 to do it? Like, make that click in your head. I'm getting paid $21,000 to buy 1,500 shares of NVIDIA a year and a half from right now when the company is going to be bigger and more profitable, most likely for $100 a share, and I keep the $21,000 in premium. That's the name of the game of one of my favorite ways to make money with stock options, which is selling put options. I buy calls, I buy puts, I do a bunch of other things, but selling put options is one of my favorite ways in the long run to scale your portfolio, get those consistent wins every single month, and you pretty much just make your own cash flow. You are in control. There's a lot more that goes into selling put options than what I could talk about in this video right here. So if you're really interested and you want to take your portfolio to the next level and learn how to value a company, when to enter, when to exit, how to manage risk, you have to do my course below. It's 60% off. I promise you it's going to change your life. You could go look it up on Trustpilot. Just type in Investing with Brandon course. The reviews are super, super strong. So if you want to check that out, link is below. But if you don't want to do my course, watch this video right here. It's just a video of my story and my life, how I scaled from nothing to over $2 million, all the things I've been through. I'll see you guys in that one.